Tim,
Mr.
welcome
Lee.
back to F.A.C.E. How are you, buddy?
Hi, Dale. Yeah, really good, mate. You?
Good. Listen, there's a rumor flying around the company that you're going to be changing your Twitter handle to the leaf blower. Is that true? And why leaf blower?
I
What
was
does
just
that have to do with it? What?
just a bit of fun, just a bit of fun with the
Okay.
yeah, the way
Anyway,
the world's going mad.
I think they should execute the guy who invented them. All right, they're the worst noise pollution in the world. Anyway, Tim, what's top of mind for you? You know, we're
Man,
about a month into the spring.
Yeah, I think I'm right there with you guys on the uncertainty. To be honest, it's really it's a tricky time at the moment. I think.
Do you want to share your screen and show us your confusion?
I can show you my confusion. Yeah, no problem at all.
The either or. You know, there are a lot of markets that look either or, but do you think that I know you're okay? We could start with the S&Ps here. Any bias here on this rally? I could see how it could trade 4,300, and I could see if it takes out 4080 that it's going to have problems.
Yeah, I mean, this is the thing that I've sort of. It feels in one way, it feels like we're becoming complacent. Okay, in a lot of things.
Oh, you mean like the 17? Yeah, 17.
Yeah, VIX is coming down. You know, there's a lot of things when you look around as well. Just published an article on just random things that we look at, like home builders. You know, some of these home builder stocks. You know, the big guys like Lennar and D.R. Horton. They're near their all-time highs. You know, and you're looking at that and thinking, well, why would they be there late cycle? You know, who's buying home builders late cycle? And I think we're just sort of getting to a point where perhaps there's a bit of complacency that we're going to get those rate cuts early, that the economy's, you know, we're going to have this inflation, the economy's going to hit a soft landing, and then we're just going to take off again. And, you know, I can kind of see that based on, I'm skeptical. I mean, it's one of those things. It's like you look at things that are possible and things that are probable. And I just don't see it as probable. Given the amount of tightening that we've had, you know, and just the general volatility of everything, you know, the data, you know, what's been going on. We've sort of gone from this massive bull market into, you know, a really sort of fast retracement down, you know, right down to sort of 3,500 in the S&P. And now we're back up where we are now. You go, okay, so where's there good value for a trade? You know, is the way that I look at it, you know, more of a kind of swing trade. And you think that there probably isn't great value until we can kind of look at a clearer picture. You know, there's no real bias right now. You know, if we get back down below sort of 4,000 again, maybe even down towards 3,800, then you think, okay, I would like to be long, maybe around the 200-day moving average there. But, you know, up here at the moment, you just look at the way the market's moving. And to me, it looks like we want higher, you know, with the VIX low and everything else. And I think perhaps we're pricing in the Fed pause and that kind of return of certainty, which we know markets love. I think there's elements of that there too as well, that we know, or at least we think we know what the Fed's going to do, which is, you know, 25 and done. And then they're going to sit there for a little while. So, yeah, I mean, I think that's what we're doing. And I think maybe, you know, if we get to sort of 4,300 area, then I think that's a short. I think for me, you know, depending on the data and the situation at the time, you know, the context, but realistically, I still think there's the majority of the pain economically is ahead of us. You know, we haven't really felt that pain yet, and we're seeing the credit tightening coming through now. I mean,
we should get the, you know, I forgot who it was who was a consummate bear because of, was it Wilson? Mike Wilson
because of earnings.
And you know, he's still singing that song, but he says he's not bearish anymore. So, I mean, haven't all the bears kind of capitulated? I don't know who's left. I think the guy from JP Morgan, Marco, might be one of those last guys left.
It's ironic, really, because he's always been the permeable.
Isn't it really going to be about the dollar? You know, there's an expression, if you get the dollar right, you get everything right. And what do you think?
I think that generally is right. But what I also think is at the moment the dollar's the hardest thing to get right, because we're going to rely on everything else against the dollar now. You know, if you work off the assumption, which I think is a fair assumption, that the Fed are going to pause at the next meeting. They're going to hike 25 and then they're going to pause, I should say. That's what I think they're going to do. We're priced at like 85, 90% chance of that. I think they deliver it and they get to sort of that magical 5% that they've all been going on about for, a few months now. And then they're done, I think. And they're probably, with their inflation sort of, the inflation picture in the US versus other economies, I think then it's fair enough for them to be done and say, we're going to hold here. But then you look around and you think, okay, well, what about Canada? What about Australia? Which they're looking, they want to hold, but they're kind of, inflation is pushing them to maybe do a bit more. You look at the UK today, especially, again, inflation is pushing them to do more. And I think that, even Japan, I'm not all over this one. I think it might be overhyped, shall we say, that the Bank of Japan will do something, but they might make another adjustment. And I think you're looking at everyone else.
So you're saying
the Fed's going to sit there. Yeah,
interest rate differentials are going to continue to not favor the dollar because of that.
Potentially. I think what we're looking at is that all of the catalysts are going to come from outside of the dollar. Is what I'm thinking. And then we're sort of, they're maybe going to feed in, because obviously on the other side of that, if you start thinking, okay. One thing that I looked at especially is obviously, Japanese insurers and pension funds buying US debt. It's not looking too good at the moment, for the costs of hedging it, with the FX and everything as well are very, very high. So, especially at the long end, it's just really not very appealing. So maybe we're actually, maybe we see higher rates, in the long end now of the dollar, which I think would be dollar supportive without a doubt. But again, there doesn't seem to be that at the moment, at least, there doesn't seem to be that catalyst to really push to that. Maybe higher inflation elsewhere, maybe even PMIs at the end of the week. We might see that actually economies are sort of pushing on again, and maybe that will just drive rates globally higher. But yeah, and sort of almost ensure the crash.
How about the geo risk of Ukraine worsening?
I just don't know the markets really care about that too much at the moment.
That's what I mean. Like they don't care at all.
No,
they don't care at all.
How would you see it worsening, Dale? If you think about it, really, it's like I can't see it sort of getting much worse than where we are now from a market's perspective. I don't see how it could really get worse.
All the NATO countries all the other NATO countries are doing drills. Looks like they're getting ready for something.
Right. Okay. So
that would do it. That would do
yeah.
it.
War would definitely do it. Yeah.
Yeah. Well, that's what I'm talking about. If NATO becomes involved in some way. Anyway,
that would be huge. That would definitely.
I know the market only cares about the Fed.
Off.
That's what I mean. Everyone's eyeballs on the Fed, and we're whistling past the graveyard with a lot of other things happening. Are there any sectors within the S&Ps? Because I've been top picking semis, which really led the way. Do you do sector work or just trade the indexes?
No, we do look at the sectors as well. But to be honest, again, it's very, very messy. I think semis definitely is going to come under a lot of pressure. I think you're bang on with that.
Why?
Just because of the overall situation with the inventories, there's oversupply. They're still spending out fortunes in building more capacity. I don't know. Did you see the ASML earnings this morning?
No.
Okay, so ASML were very, very, very strong. ASML, obviously, the company, just in case anyone doesn't know, they're the ones that are basically selling the shovels. They're selling the machines that make the semiconductors to the TSMCs and the Intels and so on of the world. And their earnings and their pipeline as well are very, very strong. So that capacity really hasn't come down. And I think it's just sat there. And as soon as there's a little bit of a spike in demand, then they're all rushing to try and meet it. And it will just keep our race to the bottom on, and in the end, no one ever wins in a race to the bottom. It just sort of compresses margins. So
even Nvidia,
I think that's a good one.
Even Nvidia, Tim, take a look, pull up the Nvidia chart.
Okay. I did a little thing about Nvidia a little while ago. Yeah, it's a very clear hype.
I'll tell you what, I'll tell you what I see. Can you put up, is that a daily?
That's a daily chart. Yeah.
Okay. So a classic 3 drives to a top formation. First down day is a signal. Can you go like make it a little, yeah, there you go. Now you'll see the
Yeah.
3. So if you had the RSI underneath NVIDIA, it's making its second lower high. And this has been the superstar of semis. Okay, so is that an RSI? Simple moving average. All right, so you've got 3 drives there, and 4 hour even shows it better. And you'll see the formation that I've taught a couple people this one. Yeah, so you had that spike up yesterday, gapped up, and look at the non-confirmations glaring.
Yeah.
So
yeah,
the
very
orange
much.
line. So semis. Anyway, I think semis, how do you divide a semi and make it a quarter? I don't know. Semi is half, right? So
yeah.
And the miners, you trade that stuff, gold
No, it's
getting
one.
hammered today.
Yeah, the miners is one that I don't ever trade, but yeah, I've been very wary of gold up at these levels as well. Again, it's just don't see the kind of the real need for the follow through. I just it just doesn't. You're looking at it, say, okay, so what are we looking at globally? We're looking at globally at the moment higher interest rates. There's no real signs of kind of greater financial repression, which I think of gold as a hedge against. So why are you going to own a zero yielding asset? When inflation is coming down and real interest rates are becoming more, well, I was going to say more positive, but really less negative is the correct way of framing it.
I bet Steve Volge would have an answer for you.
Go on. What is he listening?
It looks like he's here. He's he spies on me now during my interviews.
What's the question, Dale? Sorry.
Okay, so give Steve your reasons for why would anyone buy gold? Go ahead. One more time.
Okay, so buying gold up here. So why would you buy gold when globally interest rates are pretty stable at higher levels than they have been, and the sort of real interest rates with inflation coming down are also getting less negative?
Because I believe that real interest rates are going to go substantially lower. Inflation might actually move to the downside, but I think that rates will aggressively move to the downside more than inflation will, sooner rather than later. And I think the precious metal market is already pricing that in, has started pricing that in.
Okay.
We've already seen the Fed within a single week undoing 4 out of 8 months of quantitative tightening they have done. And in my opinion, it's a matter of when and not if they're going to go back to quantitative easing.
Okay. Yeah, fair enough. I don't necessarily disagree with that over time. But yeah, I'm not sure that this is the place to be kind of adding to that bet.
Short term, perhaps not, but in general, I think the trend will continue. I think 2023 is going to continue being a very good year for the metals. We've seen silver break through a multi-year corrective move literally a few days ago. We're seeing platinum be in the precipice of doing the same. I think this is going to be a good year for the metals, personally.
Okay, excellent.
Definitely. Thank you, Steve.
Keep an eye on. Thanks, man.
My pleasure.
For leaving your meeting to answer the question. There's a dedicated gold bull. So anytime there's a bear on, all I have to do is unleash Steve on them.
Yeah. I mean,
Steve, thank you, man.
My pleasure. I'm here.
Yes, I mean, the other side of the way that I sort of think of gold, and again, this probably is, I think, a little bit further in the future, is that generally what happens if we do go into a kind of, a proper recession, not this sort of mild recession that we've been talking about, but, a genuine downturn. Maybe, we're talking sort of more towards the end of the year, I think, before we can start credibly talking about that. But in that situation, do people continue holding gold? And I think much will depend on what inflation looks like then.
Yeah.
And again, I mean, this is something that we mentioned yesterday. Hang on, let me just see if I can bring it up here on the screen. Okay, here we go. So obviously, this is you can see this here, that my mouse on the screen, yeah?
Yeah.
Okay, so what we're looking at is obviously now inflation by sort of June time. Just purely on a mechanical basis, because we're getting rid of these big months. We're going to be below 4% on the headline. Obviously, core might be a different story. But generally, headline inflation, which is the one that's mainly reported,
And in the twos next year.
Yeah, I mean, again, I think a lot depends on the evolution of the economy there. I tend not to try and forecast too far ahead, and I think most people should take recent experiences to sort of show that that's not a good idea.
Did OPEC change the dynamics of the oil market bear a few weeks ago?
Of the bear, definitely. In terms of the bear, definitely. I just think that, again, you've just sort of got that situation where everyone's kind of trying to play off against each other, but I don't see any trends really forming at the moment in anything.
Right.
I just sort of see that it's going to be chop, false breakouts. Again, maybe we're seeing decreasing volatility as well, generally across the board. But obviously, at some point, that volatility compression usually ends up being, having the opposite effect, of course.
Do you think it's a liquidity too? I mean, I watch the S&P trade. They don't trade as tight as they used to. There's times I see one handle moves between trades.
I do think that's a general dynamic actually across markets. I think as well when you saw the same thing in the oil market after
and the bond market.
Sort of,
and the bond market's the worst, right? People can't hedge as much as they did just because of the bid offer. I mean, that used to be the tightest spread on the planet.
Oh God, yeah. And some days it would barely move.
Yeah, 64th or 32nd. Anyway, the times they are changing. So what do you think about as far as all this talk of de-dollarization and it really causing people that would never really consider or be worried about the dollar? I'm talking about the man on the street asking experts, do I have to worry about the dollar? Do you take that as a contrarian signal right here that there's, funds are real long, things like euro, real bearish dollar? Can the dollar stage a pretty good rally in here?
I mean, I think it can, and I think it will at some point this year. I just don't know again that we're right on that spot just yet, because generally the dollar obviously strengthens in times of sort of credit crunches. When anyone needs liquidity, they need dollars basically. And I think the de-dollarization thing it's always misguided. People look at things and they see a couple of countries, they've done it in yuan or renminbi or they've done a trade in a different currency, but that's not what it's about. And it's only a tiny amount of trade anyway. The biggest problem for these countries, the ones that are supposedly going to move away from the dollar, is that they generate excess savings, and they have to put those savings somewhere. And because they've got a trade surplus, they can't. That means they've basically got too much. They haven't got the capacity in their own economy, they're overcapacity in their own economy. So they have to look elsewhere to invest, generally speaking. And obviously, with the US being the biggest economy with the largest capital markets, it offers them the chance. Offers them the greatest amount of opportunities to save those earnings. And that's really what it comes down to with the dollar status. It's not what people think it is, that like the US goes around bullying the rest of the world and saying you've got to use our dollars or we're gonna bomb you or whatever, whatever the sort of recent narrative will be. It just doesn't work like that. It's constraints that there's no other economies that can take those savings, and China's a great example, because China hasn't got open capital accounts and they run obviously the largest trade surplus of all of the economies. Then that's basically you've got a choice of putting your money into the US or kind of a tiny, sort of trying to put a little bit here and a little bit there around the world. And, there's all sorts of political constraints in those other countries a lot of the time too. So the US is the least bad option sort of all of the time. And until something drastically changes, that will continue to be the case. It's not about politics. It's about constraints.
Okay. So should there be a storm, you think the US is the best place to ride it out?
Always.
Recession always has, always will be.
Until it's not the biggest economy in the world with those markets, I agree. I mean, you've got things coming up. We've got a bit of drama coming up with the debt ceiling now. I think we're due to find out how the tax collection's been as well. I think that's today. whether the Treasury is going to run out of money in June or July or when it's going to be, supposedly.
Yeah, I heard June.
Yeah, but some of that depends on the tax receipts as well, of course, what they're bringing in now. So obviously the bigger the tax receipts, the longer they can keep going. But in the end, it will get resolved, and then we'll move on, and everyone will forget about it again. But I can still see there being a bit of drama and maybe a bit of panic around the same time.
Okay, there's only one. Okay, at least you added panic. Everyone, most people with that narrative feel like, nothing to worry about, even market wise, that it's, just theatrics and it'll get done. But we've had theatrics lead to downgrades by Moody's before. So, and there are repercussions from a downgrade, right?
Yeah, absolutely. Absolutely. There are. I mean, I doubt that. I say that maybe I've got too much faith in the politicians, but I doubt that they're going to let it get to that point, because it's surely it's election, election suicide to be the one who blocks it.
Good point. Okay. Sometimes self-inflicted wounds happen without intending to do it. I don't think we've ever had a Congress like this. So,
no.
Anything you want to wrap it with, buddy? And tell people where they could follow you and.
Yeah, I mean, there's a couple of things that I would say that the biggest thing to watch at the moment is availability of credit. In my opinion,
okay.
If you're looking at tracking how the overall economy is doing and how markets are going to do, that's the thing to sort of consider. This is something that we did here on back in February. Right, this is a lagging indicator. It's not a leading one. It's just something to kind of consider. Right, that I think everyone knows the financial conditions are starting to tighten. Although people will tend to bring up these sort of indices, but there's all kind of problems with them in terms of how they actually measure what we'll call real economy financial conditions. Okay, a lot of these they're very stock market heavy. So basically, if the stock market's going up, these are going up, and they say, oh, financial conditions are getting easier, but they're actually not. Okay, so we're starting to see credit tighten. We've been starting to see it since Q4 last year. This is just a survey of loan managers here, and you can see that generally, when we get this kind of spike, I mean, I know it's a small sample size, but we get this kind of spike up, it's generally leading towards a recession, right? Which I think everyone knows is coming. It's more a case of when rather than if, I think. We're all trying to time it. Say again? And the degree. And degree of recession.
What's your intuition telling you about degree?
I tell you, I think the longer the Fed stays on hold with higher rates and tries to keep it up there, to sort of the worse the recession is going to be. And I mean, not just the Fed, all of the central banks. It's just there's the rate of change is just too fast for people and businesses to adapt too quickly.
Don't you think it would take? Really, don't you think it would take? I mean, right now it's not an emergency, but first they're going to tighten and then pause. But don't you think it's going to take 3,200 S&Ps for them to reverse and begin to? Then there's an emergency showing up in the market, or they're going to be preemptive on just based on data points, or do they need a reason like the market under a lot of pressure, which is what they wanted that they really never got, for them to start cutting rates?
I actually think it will probably be employment that does the job for them. Okay. And rather than that would be the thing that says that where they turn around and say, okay, that's enough sort of pain in the employment market. That is going to tighten things enough.
What's
Obviously,
the number
inflation
there,
needs to come down as well.
What are they looking? They want to get up to 4.5 or so. They're trying to get it to.
That's what they reckon. But again, it's like, it's. I mean, how do you micromanage an economy to that extent? An economy the size of the US. How are you going to micromanage it to that extent? It's these things, as we know, they happen with lags. Monetary policy works with lags. It's going to take time. Yeah. And the problem is that we tend to obviously because it works with the lags, we end up with the policy from sort of 12 months ago. So obviously the further along this we go, the higher sort of the higher the impact of the tightening rates is. And I just don't know that they're going to. I don't think that we're going to see necessarily sort of 3,200 in the S&P. I think that's extreme. By the time, I mean, if we actually got down there, then I think there's far bigger problems going on in the wider economy. and they would be taking all of the blame for it. You know, I kind of have a bit of sympathy with Steve's view on gold and things, is that I do think that these administrations, should we say, in terms of the Fed and in terms of, you know, the current Biden administration as well, and the timing as we're going into elections next year, I don't really think they've got the bottle to really inflict a lot of economic pain. So I think that once we're down with inflation at sort of 3%, you know, for a few months, I do think that they're already going to be making noises about cutting rates back to what they'll call a neutral level. So I kind of think the market's roughly pricing that correctly. I just don't know that they're pricing the timing of it, but sort of a return down to neutral rates, because they're seeing unemployment tick higher and they're seeing the impacts.
Can we see new? It doesn't sound like you sound pretty sanguine about the market. Can we make new all-time highs?
Not. I don't think so, unless we get another big fiscal spending plan,
Okay. It can't
which I
just
don't
be
think
monetary.
is likely. No. I don't think so, because I'll be honest, I don't think that they want to do QE again. I think there's been a realization that QE does not lead to a healthy economy. I'm not saying they won't do it. I just think they don't want to. And obviously what we saw I think what we'll see is more of that kind of lending that we saw with the banking crisis. They'll sort of make facilities available to provide liquidity, to bridge the gaps, you know, do that kind of thing, but not actual QE. You know, there's a subtle difference. You know, QE is free money, roughly speaking, you know, into the system, and obviously it finds its way through. Whereas obviously a lot of that money was quite expensive. You know, you were looking at sort of 4.5% to 5% lending rates there, which is fairly expensive bridging loans rather than QE that's stimulative.
Okay. All right, Tim, best place for people to follow you and David, Macrodesiac.
Can't find us that.
Is Macrodesiac and Aphrodisiac?
That's the general idea, yes. Sort of the love of macro, and
it's a financial aphrodisiac. All
financial
right.
aphrodisiac, exactly that.
All right.
You know, and it's not all based on macroeconomics. It's based on just looking at things, trying to take a bigger view, you know, sort of a grander view of everything that's going on and bring it all together, rather than saying, because we're not big believers in macroeconomics or the economists always getting things right. You know, we're much more believers in everyone being fallible, you know, and in trying to find where those weaknesses are, and figure out what's actually going on under the surface, and away from the sort of the models and the assumptions that underpin everything. So it's when we love doing it. So that was why Macrodesiac comes
across, and your demeanor. I feel calmer after having a conversation with you for the last half hour. You're not, you know, there's nothing real dramatic. It's stated matter of fact, and you kind of bring, you know, myself, you know, that have, like, you know, more extreme potential views back to earth. I think you're a great spokesman for your company as well, Tim.
Thank you. We might. I mean, if I'm making you feel calm,
I'd never call you a leaf blower.
Thanks, man.
You impart a lot. Yeah, Tim imparts a lot of wisdom every time he's here.
Yeah,
I learn from him.
Thanks,
Ryan, for getting me in trouble with Tim today.
You're not in trouble, Dale. But if I make you feel calmer, I might open a sideline, you know, macro therapy.
You know, I've spent plenty of time on the couch. So, Tim, really, best of luck for you and your subscribers and followers, and to you during this spring trading season. And
likewise, same to you and Ryan as well. All of you guys there.
Yeah,
speak soon.
Ryan's great.
He is.
And we'll talk in the summer.
Look forward to it, man. Look forward to coming back.
I'll need to be calmed down again by then. I'm pretty sure.
I think the summer might be the last. Summer I think might be quite fun.
Yeah, it's emotional. Well, then wait till next year's election.
Oh,
so, we have a lot of fun coming down the road.
You've convinced me. I'm definitely doing the macro therapy thing. That's it. Right. We're all gonna need it.
Everyone, Tim Vollans, you could follow him at Macrodesiac, and really appreciate you edifying our community, Tim. Good luck, my trading warrior.
Good to be there.
All
you
right.
too, buddy.
Okay, so that's a wrap, everyone. You could join the team in 14 minutes on the morning edge, and good hunting the rest of the day. Enjoyed the eclipse. You know, I think it's happening right now. Do you feel that strange energy from the eclipse? Anyone out there? Or is my tinfoil hat is lighting up, and there are rays going between the tinfoil rabbit ears. All right, Barry, you're welcome. Brick.
Nice, Richard.
All right, anyway, let's end it there. Remember, don't just count those things, Richard, Brand. Count your blessings. I'll see everyone tomorrow. Adios. See you, Tim.
Hey traders, this is Blake Morrow with ForexAnalytix. Thanks for stopping by our YouTube channel. Don't forget to like these videos, share them, and subscribe to our channel so you don't miss any of the content that we provide here for free. Thanks for stopping by. I'll see you in the next video.